Looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some Ask James questions of the day. Our first question is from Robert. He asks, I keep hearing about tariffs affecting the stock market. Is it a good idea for me to move everything to bonds and cash? All right, Robert, great question. And I appreciate you thinking proactively about protecting your money. And as you would expect, it really depends, right? It depends on where you are in your journey and what you need from your investments. What it does mean is that it's a good time to move to an income first, capital appreciation second approach, to shift your focus from just watching your account balance grow to actually generating reliable cash flow. So whether you do that with higher dividend stocks or with bonds and bond-like instruments, preferreds, fixed income securities, and similar options, it depends on two things. First, how much income you need as a percentage of your assets. If you need 3%, higher dividend stocks can work. You can find quality companies paying solid dividends that can meet that level. What if you need 5% or 6%? Okay, now you're going to need bonds, bond-like instruments. Stocks just won't reliably generate that level of income without taking on too much concentration risk in high-yield sectors. Second, your risk tolerance. And this is one people often overlook. Even high dividend stocks can drop more in value than bonds. A good dividend paying stock might drop 20%, 30%, 40% in a bad market, even while still paying its dividend. Part of retirement isn't just math, it's emotion. You have to be able to sleep at night. If your investments drop 25, 35, 50%, even if income doesn't change, even if those dividends keep coming, you may not feel comfortable. You might panic and sell at the wrong time. So ask yourself, honestly, am I okay with a 10% drop in my account value? What about a 20% drop? What about a 30% drop? That pain point tells you the right mix for you. If you can't stomach a 20% drop, you need more bonds and less stocks, even if the math says stocks could pay enough. Your peace of mind is worth more than squeezing out an extra 0.5% of yield. When you're retired and living on this money, emotional stability matters just as much as the financial returns. Great question. If you would like to send in your question, love to have it. Email that question to us. You can email it to poollocke@poollocke.com. Our second question is from Linda. She says, I've invested heavily in the Magnificent 7 stocks. I've realized I'm way too concentrated, even though they served me well. Should I diversify? Well, I'm sure they have served you well. Good job. And you're absolutely right to be thinking about this. The fact that you recognize the concentration risk, it actually shows that you're paying attention. That's half the battle. The S&P 500 has been driven by 7 stocks, not the other 493. Apple, Microsoft, Google, Amazon, Tesla, Nvidia, and Meta, Facebook. Those 7 have been doing the heavy lifting. That's changing. We're already seeing it shift. The narrow leadership that drove markets higher is starting to broaden out. An index fund may not be the answer for you at this point. If you own an S&P 500 index fund, you still have heavy concentration in those same 7 stocks. You may need something more equally weighted or individually managed, something that spreads risk more evenly across sectors and doesn't put 30, 40% of your money into just a handful of technology companies. Over the long run, equally weighted portfolios have outperformed heavily tech-weighted ones. They have less dramatic ups and downs. And they capture gains from a broader range of companies. So whether you add bonds depends on how close you are to retirement. Are you 5 years out, 10 years out, already retired? The closer you are, the more conservative you should be. The less time you have to recover from a major market downturn, the more you need to protect your principal. If you're within that critical 10-year window we've talked about earlier, you should definitely be adding bonds and other income-producing instruments that protect your principal while generating cash flow. Hey, thanks for the great question. And as always, if you would like to send in your question, you can do so. You can do so by emailing those questions to poollocke@poollocke.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me